the month you retire may be more important than you think. These calendar months can quietly cost you thousands of dollars in retirement expenses, or quietly give you more money. Most people go out on their last day at work and don't know which day they've just chosen. When you first started thinking about retirement, no one told you. You've spent decades focusing on big questions like how much money you need, when you can stop, and what your actual numbers are. These are important questions, but a smaller one is hidden beneath all of them. And until that moment, few people asked, when exactly should you retire? The calendar month you choose ends up touching almost every part of your retirement life at once, including your Social Security checks, Medicare enrollment, tax returns, pension formulas, final paychecks, and unused vacation expenses. Once you choose a month and walk out that door, many of these decisions become permanent. Let's take a closer look at what actually happened, because by the end of this video, you'll know exactly what questions you need to ask the month before you file your retirement letter. Social Security is the starting point. Because the calendar matters more than most people realize, benefits are paid a month after they are due, meaning that January benefits actually landed in February. This is a stumbling block rule. This is a small rule with practical consequences. To get a month's benefit, you usually have to be entitled to a month's benefit, with one exception: when you reach full retirement age. For most people, scheduling this time around their birthday can take a detail of an entire check. As for the full retirement age, those born in 1959 set it at 66 months and 10 months, while those born in 1960 or later will have to wait until 67. Claim before that age and your benefits will shrink forever. When you reach the retirement age of 67, filing at 62 means a permanent cut of about 30%, after which, you can get an 8% boost a year until you turn 70. This is a quirk most people have never heard of. Oddly enough, the SSA thinks you're old the day before your actual birthday, until you see how it works in practice. People born on the 1st of January, 1960, are considered to have reached full retirement age in December. An odd little rule that could change your first eligible benefit month to a full one. There is also the income test, which is important if you apply for Social Security before retirement age and are still working. In 2025, anyone under retirement age could earn as much as $23,400 a year until the agency began deducting $1 for every $2 in benefits above that limit. The year you actually reach full retirement age, the ceiling jumps to $62,160, and the withholding tax drops to $1 for every $3 or more. This means that the month you stop making money may have a direct impact on how much benefits you actually keep in that year. And Medicare, where bad timing can cost you the rest of your life. Starting at age 65, you will receive an initial registration period of 7 months, covering the first 3 months of your birthday month, the birthday month itself, and the 3rd month after your birthday month. If you miss this window, every 12 months you qualify but do not register, the penalty for delayed registration in Part B will increase the premium by 10%. The penalty is not a one-time penalty, but a permanent premium surcharge as long as you have Medicare. The standard Part B premium for 2025 is $176.1 a month. By itself, a 10% fine sounds small, and that is the catch. Because mixing more than 20 or 30 years of retirement turns it into real money for the rest of your life in a missed window. Another small detail is important here. Anyone born on the first day of the month will see their Medicare coverage begin a month before their 65th birthday, and birthday quirks reappear. To be honest, for most people, retirement months have the greatest impact. Imagine that when you retire in December, you've earned a full year's salary, and your employer might save up a year-end bonus. And then they'll write a check for all your unused vacation days. All of this is in the same tax year, which means that the moment you retire, you basically accumulate your highest income year. At the start of the new tax year, you have almost no salary on your books, compared with retiring in January. That year's low income suddenly became priceless, opening an ideal window for Ross to convert, reap capital gains, or restructure your portfolio at a much lower tax rate than you've seen for years. That is why some financial planners refer to people retiring by the middle of the year, in June or July, because you get a tax grade divided into half a year's work income and half a year's retirement income. The easing of the transition cannot be replicated in December or January. December also has a real advantage, which is the other side of the coin. If you complete your full year 401 contribution, you may receive another year of pension service credit, which will effectively replace the lower year and increase your benefits if you earned more in the previous year than you currently earn in your Social Security calculation. Social Security is based on your highest index income in 35 years, and anyone below 35 years will see an average of 0. For some, staying home in December has nothing to do with wages, everything to do with replacing 0 years or younger within the 35-year average. Federal employees face a more specific version of the conversation. Pensions under FERS and CSRS are calculated based on a formula linked to your highest average wage, usually 3 times higher, meaning retirement before a planned raise may permanently reduce the base. The day you leave matters, too. FERS employees who retire on the last day of the month will start receiving an annuity on the second day of the next month, while CSRS employees under the old system can retire on the first, second, or third day of each month and start receiving an annuity immediately. This is a rare situation where you can basically get both an employer and a pension for part of the month. Federal employees also need to plan around leave. Most positions allow you to carry forward up to 240 hours of annual leave, and any additional time accumulated before retirement is returned as a one-time salary. At the right time, you can control its tax year, and if you get it wrong, you can add it to your annual salary. One bonus detail that many federal employees forget is that unused sick leave will never be paid, but it will indeed be added to the pension calculation service you trust. Service milestones can be reached in a few weeks, sometimes more valuable than wages themselves. IRMAA is next and rarely makes headlines. The acronym stands for Income-Related Monthly Adjustments, or surcharges that high earners add to Medicare premiums. This is a trap because IRMAA is based on your tax return from 2 years ago. Retiring in high-income years means payback, and raising Medicare premiums within 2 years is when you think you finally adjusted to a quieter financial chapter. A form called SS-44 allows you to claim deductions based on life-changing events like retirement, but only if you know it exists and actually submit it. A few more details are worth mentioning because few people talk about them. The Social Security cost of living adjustment will take effect in December and appear in your January payment. Coke production was 2.5% in 2025, 3.2% in 2024, and 8.7% in 2023, one of the biggest adjustments in decades. The month you start collecting benefits can determine whether you're riding a wave of Coke or just missing it. Your Social Security contribution date also depends on your birth date. People born between the 1st and 10th are paid on the 2nd Wednesday, the 3rd Wednesday from the 11th to the 20th, and the 4th Wednesday from the 21st to the 31st of each month. That doesn't change the rules of the game, but it is important when you reconcile cash flow with mortgage payments, bills, or required minimum distributions. With the signing of the Security Act 2.0 into law on the 29th of December, 2022, the required minimum distribution now begins at age 73. Under the same law, the RMD age will climb again to 75 in 2033. Let's connect. The month you retire is not just a calendar date. It is a deciding point for how much Social Security you get, whether you avoid lifetime Medicare fines, which tax year your final salary and bonus will fall, whether your pension base will catch up with your final raise, how much you spend on unused leave, when your Medicare premiums will climb, and whether you can replace 0 with a 35-year average of Social Security. December offers you a maximum contribution, a full bonus, and an additional year of income credit. January offers you a clean, low-income tax conversion and planning year. The difference can be split in the middle of the year, and the tax shock can be alleviated. Federal employees, who deal with more specific dates, can squander thousands of dollars in one way or another. It is worth noting that not everyone has a perfect month, because not everyone. The point is that this is a real decision, with real consequences, and worth thinking about. If your retirement is less than a year or 2 away, sit down and put your calendar in front of you to see how your birthday aligns with Medicare, how your pension formula compares to your next planned raise, and where your bonus plans, vacation balances, and taxes are this year and next. If all of this feels overwhelming, that is why there are fee-only retirement planners who can pay themselves multiple times in the hours leading up to the retirement date. The day you walk out that door is the only decision in the process, and you can't walk back easily, so open your eyes and choose a month.